What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Happy Thursday everybody, welcome back. For the last few weeks, investors in Chinese stocks have been on a bit of a roller coaster, seeing massive swings in share prices, with even indexes seeing daily double-digit movements. For example, last Wednesday, the Nasdaq Golden Dragon China Index, a modified market capitalization weighted index comprised of companies whose common stock is publicly traded in the United States and the majority of whose business is conducted within China, after dropping to a price down 70% year on year, jumped 30% in one day of trading. Now, some may argue that this is just a result of the general volatility we are seeing in international capital markets. While this is a factor, international inflation, commodity prices, and geopolitical instability in Europe are indeed affecting Chinese stock prices. However, the intensity of the volatility with Chinese stocks specifically is far greater than what we have seen in, say, North American equity markets. And Chinese stocks have dropped to much lower points. As of the filming today, the above-mentioned Nasdaq Golden Dragon China Index is down over 50% year-on-year, while the Nasdaq 100 Index is up 12% year-on-year. So what is going on? Today we're going to do a deep dive into this question and think about what we should expect from the Chinese stock market and general equities markets going forward this year. Chinese stocks, and in particular technology companies like Alibaba, Tencent Holdings, which owns the massively popular WeChat application, and Meituan, another major internet platform company in mainland China, and others had already been taking a hammering in recent months. Economic slowdown, the Evergrande housing crisis, COVID lockdowns, and critically for technology companies, a series of regulatory crackdowns on both the private education sector as well as technology platforms generally had damaged investor confidence, and billions of dollars of bleeding had already resulted. But the most recent hit to Chinese share prices came on March 8th. On that day, the US Securities and Exchange Commission named 5 Chinese companies that could eventually be delisted from US exchanges because American regulators cannot get access to their audit work papers. 2 days later, US traded Chinese stocks began to fall in a massive plunge that lasted 3 straight trading days. By the end of these 3 days, the Nasdaq Golden Dragon China Index dropped almost 30% and was down 70% year on year. A source speaking to Chinese financial media outlet Tencent explained investor fears, expressing, and this is their English, not mine, quote, "Although it'll take 2 years if these Chinese companies were to be delisted from the United States market over auditing issues, some institutional investors are dumping them all once the companies made into the provisional delisting list, as managers of pension funds, university endowments, and mutual funds are prudent to avoid risky assets." End quote. Hong Kong-based financial analysts argue that this US sell-off spread to the Hong Kong capital markets, with the Hang Seng China Enterprises Index, which tracks Chinese mainland companies listed in Hong Kong, plummeting 15.6% from March 11th to March 15th. We remember that it was during this period when JP Morgan Chase & Co. downgraded Chinese internet companies and told clients that these companies were uninvestable. More on this shortly. On Tuesday of last week, China officials said that they were in talks with the US side to deal with the issues that the SEC has with Chinese companies listed in the United States. This stabilized the fall on Hong Kong and mainland markets. Then on Wednesday of last week, a very likely nervous Beijing brought out the big guns. The State Council's Financial Stability and Development Committee, the top financial policy committee in the country, addressed market concerns over risks from the property market, internet companies, and overseas IPOs, basically promising that the government will stabilize capital markets by not messing around with major companies, expressing, quote, "Any policy that will have a significant impact on capital markets should be coordinated with financial management departments in advance to maintain the stability and consistency of policy expectations." End quote. This was the signal that Chinese investors were looking for, at least in the short term, for speculative gains. The reassurance from regulators cushioned investor confidence. Fear quickly turned to greed, And from a very low base that day, last Wednesday, share prices in Chinese stocks skyrocketed on the mainland and on the Hong Kong exchange. Once US markets opened later in the evening, East Asia time, or Wednesday morning US time, investors in North America poured into Chinese ADRs. And we remember ADRs, which mean American Depository Receipts, are US bank-issued certificates representing shares in a foreign company for trade on American stock exchanges. This is when we saw the Nasdaq Golden Dragon China Index jump 30% in just one day, like we mentioned before. Alibaba's ADR jumped over 40%, and Chinese company Pinduoduo shot up over 50% on US markets in one day. Again, these were all from low bases. Alibaba, after all, is still down 50% year on year. At this point, it's worth taking a step back and looking at just how much Chinese capital markets are driven by investors' views of the moves of the government rather than the health of any given company or the general macroeconomic environment. Although I guess some may argue that the US Federal Reserve can also have similar influence over investor decision-making in North America. By the way, guys, if you're enjoying the content, it's always a massive help if you hit the like button. As a small channel, it's one of the best ways you can help the channel grow and get shown to more people. If you're watching for the first time and you're getting some value from this episode, maybe consider subscribing. I release one of these every day, so if you want to be on top of the most up-to-date analysis on China, hit subscribe and that bell notification. And one more thing before we carry on, guys, because we are discussing markets and equities specifically in today's episode. As always, this video and the content in this video is not direct investment advice. If you're thinking about investing, you should speak to your own investment professional who understands your situation best. That was the last 2 weeks, a roller coaster in the trillions of dollars. Is the volatility over? No. Putting aside the uncertainties and instability of the international environment, from the war in Ukraine to rising interest rates, within China itself, the market situation remains concerning and deeply uncertain. As we have seen in recent China updates, Beijing's tough and highly disruptive measures to contain COVID-19 outbreaks across China are now really hurting the economy, with JP Morgan recently changing its forecast for Chinese growth this quarter to 0%. That is no growth. As we know, the housing crisis is ongoing too, with 2022 looking to be a worse year for developers than last year. And in my opinion, that once there is some stabilization in capital markets and growth, there will be renewed regulatory crackdowns on areas of the private sector, especially in technology and internet companies, making long-term investment in these sectors very difficult. But then the following day, Chinese technology stocks saw a 2-day rally on Tuesday and Wednesday of this week as share buybacks by Xiaomi Corp and Alibaba Group Holdings Limited spurred hopes that other companies may follow suit. In Hong Kong, some investors worry that there's plenty of room left to fall, while others believe Chinese stocks still have promising long-term prospects. For example, the chief investment officer of Hong Kong-based Triata Capital Limited, TRIATA Capital Limited, expressed this week that the plunge in Hong Kong stocks have created opportunities for investors to buy the dip, as the shares of some internet and technology companies remain worthy long-term investments. Another investor, speaking to financial media outlet Yicai, expressed that if you deem them to be good companies and are willing to buy their shares when the valuations are high, then, quote, there's no reason to not buy when their valuations hit lows, end quote. And as we saw yesterday, as we discussed yesterday, fund managers with the China-registered unit of BlackRock Inc., the world's biggest asset manager, told investors that on China, Hong Kong-traded stocks have become quote-unquote extremely attractive after recent declines. We remember that BlackRock became the first foreign firm allowed to start a wholly owned mutual fund business in the Chinese mainland. That's what we're seeing in Hong Kong. What are investors in the mainland saying? Well, global investors' net selling of mainland stocks throughout the Stock Connect program linking Hong Kong and the mainland exceeded 20 billion RMB, 3.15 billion in the first 2 days of last week. A private fund manager speaking to Chinese financial outlet Tencent expressed, quote, The outflow could be a result of foreign institutions' risk aversion, as Europe and the United States doubled down on their Russian sanctions and the Moscow exchange closed. Investors worldwide are facing liquidity shortages and are selling off assets to replenish their cash. End quote. But then went on to express that despite the authorities' move to stabilize share prices, here referring mainly to the Wednesday meeting last week, it is likely that, quote, the market hasn't bottomed out yet because it will take time for any policy changes to take effect. End quote. And finally, what is the sentiment of investors in the United States towards US-listed Chinese stocks? Well, it seems that global investors, particularly in North America, have been pulling away from Chinese stocks for some time now. SEC filings show that the share of US-traded Chinese stocks in the portfolios of American mutual funds and pension funds fell from 7% in the third quarter of 2020 to 4.1% in the fourth quarter of last year. As we have already discussed, JP Morgan recently downgraded 28 Chinese internet companies listed in the US and Hong Kong, calling them uninvestable. However, they stressed that this is just in the near term. Quote, we believe that China's geopolitical risks, along with escalating volatility across all asset classes and weak equity performance of global growth sectors, make risk management as the most important consideration for investors with a global mandate in relation to their China internet investment strategy. End quote. With the size of China's economy, what happens here affects markets around the world. And with such a complex situation on the ground here, China markets are harder than ever to anticipate. However, on China Update, we will continue following trends and developments closely to keep on top of things and maybe just be a few steps ahead of international media, commentators, and investors. See you tomorrow. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.